Warren Buffett.
Warren Buffett also firing a warning shot about U.S. trade policies.
The time has arrived where Greg should become the chief executive officer.
After more than 60 years of shaping American business, Warren Buffett is stepping down. But the real story isn't that he's leaving, it's what happens next. Buffett turned Berkshire Hathaway from a failing textile company into a conglomerate worth a little over $1 trillion. And whenever markets looked uncertain, his calm words stopped investors from panicking. His yearly letters were must-reads, and his annual meetings packed arenas. Soon that steady voice will go quiet, and Wall Street's most trusted guide will close his notebook. Before we can guess what happens next, we need to understand why Buffett mattered so much in the first place. Berkshire Hathaway didn't begin as a giant. In the early 1960s, it was a struggling New England textile mill. Buffett bought shares because they looked cheap, then took control and used the company as a base for future deals. He folded in insurance firms like Geico, bought big stakes in Coca-Cola, American Express, and later Apple, and picked up railroads, energy utilities, and dozens of small hometown businesses. Each purchase followed the same rule: find a durable business at a sensible price, and let it run without interference. The method behind that rise was clear and strict. Buffett looks for companies with easy-to-understand products, loyal customers, and managers he trusts.
We now and in the future are eager to buy parts of wonderful businesses, or all of them.
Once he buys, he plans to hold for years, often decades. His favorite holding period, he likes to say, is forever. Because Buffett stayed calm when everyone else panicked, he turned into more than a rich investor. He became a market anchor.
People talk about a fog of war, but there's a fog of panic too. And during that panic, you're getting inaccurate information, you're hearing rumors. If you wait till you know everything, it's too late.
During the 2008 financial crisis, his public bet on America, buying preferred shares in Goldman Sachs and later Bank of America, sent a clear signal that the system would survive. At other shaky moments, a single reassuring line in his shareholder letter was enough to cool nerves around the world. In short, Buffett didn't just earn money, he earned trust. That built-in sense of safety is exactly why the timing of Buffett's exit raises eyebrows. At 93, he's long made light of his age, joking that Coke and peanut brittle keep him going.
If I want to live a long time, I should keep eating like a six-year-old, which I do. And it works.
In recent shareholder letters, the normally upbeat prose slipped in health hints, a reminder that the big elephant deals would now be hunted by his team, or a note that Berkshire's future managers will write you next year. Those hints matched what was happening behind the scenes. Over the past decade, Buffett has quietly moved day-to-day authority to Greg Abel, the Canadian executive who runs Berkshire's non-insurance businesses. Meetings once led by Buffett now feature Abel at the center. When journalists ask who makes the final call on new deals, Buffett points across the table. But age and delegation don't tell the whole story. Buffett has always played a long game, and stepping down now may reflect a careful strategic clock. The market is near record highs. A smooth transition in good times strengthens investor faith before the next downturn tests Abel's leadership. Internally, Berkshire's businesses have matured. Railroads, utilities, and Apple stockpile stable cash that cushions any bumps a new CEO might hit. In short, this isn't a sudden goodbye. It's the last move on a board he's been arranging for years. The question is whether that long preparation will be enough for the man now taking the seat. Choosing the moment of his exit was Buffett's last careful move. Now the focus turns to the man who will carry Berkshire forward, Greg Abel. Greg Abel, 62, grew up in Edmonton, Canada. After earning a commerce degree, he started as an accountant at PricewaterhouseCoopers, PwC, then moved into energy. In 2000, he took charge of Mid-American Energy, which later became Berkshire Hathaway Energy. That unit's steady profits, and Abel's calm way of running it, won Buffett's trust. By 2018, Abel was vice chair of all Berkshire businesses outside insurance. Abel leads very differently from Buffett. Buffett charms crowds with plain-spoken stories and folksy jokes. Abel keeps a lower profile and digs into operations. Do investors trust him? Early signs say yes. When Buffett named Abel as the next CEO at the 2025 annual meeting, the crowd gave a 10-minute standing ovation.
The time has arrived where Greg should become the chief executive officer.
Berkshire's share price barely budged in the days that followed, a market signal that Abel was already priced in. Analysts point out that he has been running most of Berkshire's daily business for years. The bigger question is how Abel will balance change and tradition. His energy roots suggest he may keep pushing into renewables, yet he has also defended coal plants when they still earn solid returns. That pragmatism hints he will stick to Buffett's core rule: do what makes money over the long run, while letting each unit shape its own future. That balanced mix of caution and boldness sets the stage for the bigger test. What happens to Berkshire without Buffett? First, look at investor confidence. Since Buffett flagged Greg Abel as his successor, Berkshire's share price has moved in line with the S&P 500. That steady line shows investors aren't rushing for the exits, but they're not bidding up the stock for a new era premium either. The market is giving Berkshire the benefit of the doubt, waiting to see proof before making a judgment. Second, drill into the structure that supports that calm. Berkshire is a loose group of about 80 operating companies and a giant stock portfolio, all plugged into a tiny home office of roughly 30 people. Omaha only sets two big levers: where the cash goes and how much risk to take. The fuel for that engine is insurance float, the billions in premiums Geico and Berkshire Re collect long before paying claims. That float, plus steady railroad and utility earnings, gives Berkshire a river of cash to pour into bargains without needing big loans. But numbers don't tell the whole story. For decades, family-owned firms agreed to sell only because Buffett promised they could keep their culture. Lenders offered crisis-era cash at friendly terms because they trusted him to pay it back. Those soft advantages, the Buffett halo, never show up on a balance sheet. Yet they cut Berkshire's costs and boosted its deal flow. Without that halo, Abel may pay closer to market prices for future takeovers, and bankers may offer less generous terms when storms roll in.
So can the model outlive the personality? The math says yes. Strong cash flow, low leverage, and local control all point to resilience. What's untested is whether a new voice can deliver the same calm when panic strikes.
Warren Buffett built Berkshire on two simple habits: buy great businesses and wait. That measured pace beat every boom and bust cycle for 6 decades, yet markets now prize speed, momentum, and meme-like narratives. Buffett leaving doesn't just end a chapter, it closes a book. His exit signals a turn from fundamentals to a faster, data-driven era where patience is a rarer edge. Greg Abel inherits a fortress balance sheet and a culture of decentralization, but he must earn the softer asset Buffett supplied: trust. The first real downturn of the Abel era will reveal whether Berkshire's model can thrive without its storyteller-in-chief. Let us know what you think in the comments below, and subscribe to Business Boss for more interesting business stories and deep dives. We'll see you in the next one.